If you woke up this morning, looking up at Brutus holding the knife, you saw an ally plunge a blade into the back of the United States dollar, and the weapon, 1.2 trillion in US debt being dumped onto the market by Japan. Japan, the country we rebuilt after World War II, the country we protect with our Pacific Fleet, the country that's supposedly our closest ally in Asia. They just began the largest coordinated sell-off of American debt in modern history. This is a survival mechanism. This is forced liquidation, and it's the beginning of the end of the treasury market as we know it. Let me paint the scene. On January 6, 2026, at exactly 8:47 p.m. Eastern, the Bank of Japan issued a statement. A PDF dropped on their website in Japanese. They were exploring options to stabilize the yen. That is central bank code. That is the language they use right before they light markets on fire. Within 90 minutes, the overnight Treasury futures market in Chicago began to crater. The algos detected the liquidity shift before any human analyst on CNBC even read the statement. By 11:15 p.m., the 10-year Treasury yield had spiked 42 basis points. That is not normal volatility. That is a gamma flip. That is what happens when a major holder stops buying and starts dumping. Japan holds roughly $1.1 trillion in US Treasury as of December 2025. That makes them the largest foreign holder of American debt, bigger than China. China has been slowly reducing positions since 2022. They're down to around 800 billion. But Japan? Japan kept buying. Japan kept supporting the auction. Japan kept recycling their trade surplus into treasuries, because that's what allies do. That's what the post-1945 financial architecture was built on. We defend them militarily. They fund our deficit. It's a deal. And that deal just got ripped up and tossed in the garbage. Now, before we go further, you need to understand something. Japan's currency, the yen, has been in freefall since the Federal Reserve started hiking rates in 2022. In January 2021, $1 bought about 103 yen, normal range, stable. By October 2022, $1 bought 152 yen. That's a 47% collapse in 21 months. The Bank of Japan tried to hold the line. They spent $62 billion in September 2022 trying to defend the currency. It didn't work. The yen kept falling. By December 2024, we were back near 157 yen per dollar. And now, in January 2026, we just spiked to 161, new multi-decade low. And here's why this matters. Japan is the world's third largest economy. They import everything: oil, natural gas, food, raw material, priced in dollar. When the yen collapses, their import costs explode. Inflation goes parabolic. The public panic. And the Bank of Japan has exactly two choices. They can raise interest rates to defend the currency, or they can sell dollar reserves to buy yen and prop up the exchange rate. But here's the problem. If they raise rates, they collapse their own economy. Japan's debt to GDP is around 260%, the highest in the developed world. Their government cannot afford higher rates. It triggers a sovereign debt spiral. So they have to sell dollar. They have to dump treasury. And that is exactly what is happening. Let me walk you through the mechanic, because this is where it gets ugly. Japan doesn't just hold treasuries in a vault. They hold them as collateral in the repo market. They rehypothecate them to fund their own banking system. When they sell treasuries, they're pulling collateral out of the global financial plumbing. That creates a liquidity cascade. The algos detect the collateral withdrawal. They front run the next seller. The gamma flip. The volatility shock accelerates. And suddenly, the entire treasury market is pricing in forced liquidation instead of orderly auctions. And the data says this is already started. On January 3rd, 2026, the US Treasury held a 10-year note of standard issuance, $17 billion. The bid-to-cover ratio came in at 218. That is weak, below the 12-month average around 2.4. Indirect bidder participation, which is mostly foreign central banks, came in at 54%. That's the lowest since March 2020. Translation: foreign buyers are stepping away. So primary dealers, the big banks required to buy what doesn't get sold, get stuck with the remainder. And those banks do not want to hold long-duration treasuries in a rising rate environment. So they hedge immediately by shorting futures. And that shorting pressure feeds the algo selling. It becomes a doom loop. Now contrast that with what China has been doing, because this is the geopolitical angle nobody is talking. China has been quietly reducing treasury holdings since 2022 from around $1.1 trillion down to around $800 billion. But they did it slowly, over years. They reinvested proceeds into gold, commodities, and infrastructure. It was strategic, calculated. Japan does not have that luxury. Japan is being forced to sell in size in a compressed time window because their currency is collapsing in real time. This is not a strategic pivot. This is a financial emergency. And here is the part that should terrify. If Japan sells anywhere close to $1 trillion in treasuries over the next year, somebody has to buy them. The Federal Reserve is not buying. They're doing quantitative tightening. They're shrinking the balance sheet. The ECB is not buying. They have their own sovereign stress. China is not buying. They're selling. So who's left? Domestic buyers, US pension funds, US insurance company, US retail. And they will only buy if the yield is high enough to compensate.
Global Gold for those that are based in America and Canada. And for those in the UK and Europe, we have Allvesta.
Get yours now. Charlies.gold.